Let's broaden out our conversation and take the calendar into mind, as we must do as options traders. Cem Karsan is with us, Senior Managing Partner at Volatility Advisors, the Gamma King of Chicago. How do you like that?
I like that. Instead of Sausage King, I like what you did.
Right.
Yeah, no, absolutely.
So we're in that period, right, where things might get kind of weird the next couple days or something?
It's March OPEX, big quarterly OPEX. They're always important, the most important, but not just important when the moment comes right after, all the way leading into it. And this is what we talked about a month ago. We talked about as you got past that first week of that OPEX cycle, if we weren't seeing any weakness, right, if it wasn't happening, you better get in, with all feet in, right, all hands, because what's coming? Vana and charm flows, right?
The windows of weakness didn't manifest, so when they don't, you stay into the market.
Big quarterly OPEXs have big open interest. They have a lot of skew. What does that mean? That means the dealers are short stock, short put at the index level, which means ultimately when those buybacks happen, they come in force, and you got to get out in front of them, and that's what we've been seeing. I think the CPI number day was the biggest example. Everybody kind of just ignored the fact that CPI was super negative and that the market was up, 50 points, 60 points, right? Just every Bloomberg, every network out there, except for maybe here, right, is out there saying, well, I guess, inflation doesn't matter, whatever. What's the why?
I appreciate
why?
the exclusion.
Tell me why we were up, right?
I appreciate the exclusion.
You get it. Why were we up? It's because the event vol comes down. It's because that Vana and charm flows pushes all that buyback into the market, and here we are, right in that perfect point of that cycle. So we've had, since we started talking about how inflation would be hot and how the term structure would increase about 3 months ago, guess what we've seen again? Every number is hot. I keep calling it transitory 3.0. Eventually that's going to catch on. It doesn't have quite the ring and some of these other things. That's the reality. The Fed is ignoring it. They're not going to admit to that it's transitory. Why?
We're warming again.
Yes, but why? But why are they continuing to ignore that? Because it's an election year. Because it's an election year, because they need liquidity. It is a stagflationary environment. Another word we've been talking about. Everybody was talking about soft landing. Guess what? Stagflation. The Fed is in a box. They got to choose. Are they going to choose inflation or are they going to choose growth? There's not a right answer, but they're definitely not being Volcker. They're being Burns, and they've been that very clearly since December when they came out and announced it, despite 5 of 6 numbers being very hot. Not kind of hot, very hot.
Yeah. You think we're still getting to 5% on the 10-year this year?
I do.
Despite that election, stuff?
Everything continues to point in that direction, right? And as long as the cyclical pressures of fiscal spending and monetary stimulus continue to push forward, that inflation is going to continue to get hotter. They're not fighting inflation, right?
Yeah.
They are underpinning growth. And what does that mean? That means asset prices go higher, both from an inflationary effects and from liquidity effects. But ultimately, that's not great. I want to put some important stats out there. I think these are kind of mind-blowing. People are not spending enough attention on this simple fact. People talk about election years and how they're positive. If you look from 1928 through 2020, right, that big data set of elections, about positive 11.5%.
Right.
Sounds pretty good. Positive about 83% of the time.
4%. Percentage points better than the average S&P return.
3% above average returns, exactly. Now, but what people don't talk about is how concentrated those returns are. If you look at the last populist period, I've been very clear about how we're in this very populist period. Election years matter way more. 64, 68, 72, 76, 80, 5 years, and 2020, which was clearly a fiscal year. You can take that in or out if you want. That is the same. Every single year is positive double digits. Every single one of those years, positive double digits. The average return, 21%.
Wow.
That is only 6 elections out of 23. And if you take those populist elections out, what's the return? 5%.
So you're picking a specific group of elections here that you feel meet inflationary periods or populist periods?
Both
80, 76, 72, 68, and 64.
The last inflationary period and the recent inflationary period, which are populist periods, by the way.
Yeah.
And those things are connected. We've talked about that. Why are those better years? Pretty obvious. What happens during populist periods? Populism, people right, want handouts. There's also very contested elections. All of those elections were contested. 64, 68, 72, 76, 80, every single one was a president change, except for one, which was Nixon, and he got kicked out of office. What happened in 2020? Same thing. This is a populist period. It's a confrontational period. There's lots of need to spend to get those votes. People want spending. That is what you are going to see, and you're going to see support for that from monetary policy. And what does that do to assets? The same thing it does to inflation. It inflates them in those years. Now, so remember, 68 to 82 is a period, though, right? 14 years. What happened? The market went nowhere in nominal terms and lost 70% of its value in real terms. You take the 5 elections during that period out of that data set, what does the average year do in nominal terms? 12% negative. 14-year period, remove 4 really positive years. 5 really positive years, incredibly negative. The other 9 years are almost all negative except for one, and very negative.
All right, I like
so
this
you're
take.
in a very, very, very negative period because of populism, but within the context of it, you are in a very pointed, very forced spending period, much like 2020 was, by the way. We can talk about COVID and why, but
how does it rank? How do those forces rank compared to the options stuff, compared to the macro data? It sounds like it's clear you think the macro data ranks below the election forces.
They're not, to be clear, one operates on a much longer time frame, on a 1-year time frame. The flows, when I talk about more the options flows, the short-term kind of liquidity changes that happen as a function of mechanical effects, happen on much shorter time windows.
Okay.
So in shorter time windows, the shorter-term flows matter. Over a year period, the other one is dominant. Right?
Let's talk about that. Yeah. What level needs to hold here around this expiration to prevent us from giving back gains?
I want to be clear. I think we're going to get, I was very positive for the last 3 weeks, right, into this election and into Wednesday. We said Wednesday, which is that typical cutoff day, you start to see more room for, less positive flows and some weakness. So this is a period of digestion within a broadly very positive year cycle.
Okay.
What does a digestion look like? That means it could be in time. It could be in price, right? But the idea here is that this is not a period to be chasing the upside, right? This is a period to be looking for a buyable dip, right? And that buyable dip could be 3% and it could be 10%.
Okay.
Right? But what it's not going to be, in my opinion, is 20%, right? It's not going to be market down, vol up. It's going to be market down, vol down, at least within the context of the front of the term structure. What we are starting to see, and this is going to be a little inside baseball, is significant support to longer dated vol. We've been talking about market up, vol up for quite some time, and we're seeing a dramatic amount of that. That has thinned out the supply of vol. For the first time, we're seeing less vol supply in the longer part of the curve, 2 months, 3 months out. That has created a place where dealers are now short that and chasing to buy that back. But in the context of that, they are still getting vol in the front end of the curve. Why? Because these March OPEXs are high. They're decaying into cheap vol in the short term, which is forcing calendar expansion. It is a momentum effect and a chase that is happening. So calendar expansion is the play here into a decline.
That's been your trade basically, right? Which is to own long dated out of the money calls, sell stock against it. That still is the trade for now.
That still is the trade, and that's the trade this year.
Okay.
I want to be clear. But there are times you want to not just, if we go market down, vol down, that trade's not on its own. It's not going to do as well.
Because that trade's basically for the opposite.
Correct.
Market up, vol up.
Now, it's still the least bad way to be long vol because you're moving away from your vol and your short stock.
Okay.
And if you're in it longer dated and the calendars are big, you'll do okay in the longer dated stuff. But there's a better way to play that, which is to write puts and short stock more against it. So short put, short dated, long call, long dated, short stock. That's the trade for the next couple of weeks. Ultimately decaying longer, getting longer dated calls to play the other trade again.
All right. And looking for buyable dips.
Absolutely.
All right. Unless NVIDIA leads the dip and then steer clear, run away?
It's never easy, so that probably means it won't be 3%. Maybe it's 10%.
Well, I guess the only way we dip right now is if NVIDIA dips.
The point is it's a buyable dip and that the liquidity is here, and this is going to be a positive year. Now, whether or not that's a digestion in time or a bigger decline, we will see.
All right. Thank you, Cem Karsan. Great catch up.
Thanks.
Appreciate it.
Great to see you.